Shares of HIMS and HERS Health on the move this morning.
I think HIMS and HERS stock could 10x in value over the next decade.
This is an emergency podcast. We've got a ton to discuss. This was going to be an earnings podcast, but just this morning, the semaglutide shortage was officially declared.
Why in this quarter's HIMS report could be the difference between turning a small stake into a fortune or getting left in the dust? Will today's numbers ignite a parabolic run or spark a sell-off that erases weeks of gains? Stick around, because missing what comes next might be the costliest mistake you ever make. Last time HIMS beat on every front: revenue, subscribers, cash flow, yet the stock still plunged 8% after hours. Think about that. A blowout quarter triggering a sell-off. Today, the stakes are even higher. In this video, we'll break down why the end of the semaglutide shortage won't derail growth, how a 10 million subscriber goal maps to nearly $9 billion in sales, and reveal the 3 precise price zones where you must be ready to buy, lock in gains, or step aside, so you can capitalize on the next big swing.
Over the past month, HIMS and HERS shares have exploded higher, gaining approximately 90% as the stock raced from its April trough of $23.97 on April 7th to an intraday peak of $50.56 on May 6th. That surge formed a clear upward channel. Each dip into the $24, $30 range consistently attracted buyers, while rallies repeatedly stalled around $48, $51. As of today's close at $49.49, HIMS sits just below the channel ceiling, putting it on the verge of a breakout above $50. A decisive move past that level would target the recent high near $60, but failure here could send the stock tumbling back toward initial support in the $30, $35 zone. This pattern of higher lows and higher highs confirms strong institutional and retail demand at each pullback, and underscores why precise entries near $30 and profit-taking around $50 can maximize risk-adjusted returns. When HIMS and HERS reported Q1 2025 results, revenue soared to $586 million, a 111% year-over-year jump that closely matched management's own forecasts. Even though gross margins slipped from 82% to 73%, the company still produced $91.10 million of adjusted EBITDA, a 15.5% margin that ranks among the best in telehealth, and net income climbed to $49.50 million, an 8.5% net margin. Despite heavy reinvestment in marketing and technology, subscriber growth remained robust, as HIMS added 137,000 net new members to reach 2.4 million total, up 38% year-over-year, and average revenue per user jumped 53% to $84 per month. Cash flows were equally impressive. Operating cash flow leaped 322% to $109.1 million, and free cash flow surged 321% to $50.1 million, demonstrating exceptional cash conversion power even after capital spending. On the balance sheet, HIMS held $707.5 million in total assets against $230.8 million in liabilities, yielding a conservative debt-to-equity ratio of 0, an asset turnover ratio of 0. 83x confirmed that management is squeezing solid revenue from its asset base. Looking ahead, guidance for Q2 calls for $530, $550 million in revenue, and $65 million of adjusted EBITDA, about a 13% midpoint margin, reflecting caution amid subscriber mix shifts. The long-term roadmap still targets $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030, goals that imply roughly 23% compound annual growth and hinge on hitting 10 million subscribers, which could unlock nearly $9 billion of annual sales.
1. Profitability ratios. Profitability ratios show how well the company converts revenue into profit. Gross margin. HIMS has a gross margin of around 77%, reflecting strong pricing power and scalability in its digital health model. Operating margin. Still negative, around 2% to 5%, but significantly improved from past years. Net profit margin. Margins are inching toward break-even, indicating they are on the path to profitability. Return on assets, ROA. Slightly negative, indicating the company is still in growth investment mode. Return on equity, ROE. Also negative due to early-stage reinvestments and limited earnings. 2. Liquidity ratios. Liquidity tells us about short-term health. Can HIMS pay off its bills? Current ratio, around 3.4, which is very strong. HIMS has plenty of current assets to cover its current liabilities. Quick ratio, similar to current ratio, since inventories are minimal in their model. Another signal of healthy liquidity.
3. Efficiency ratios. Efficiency ratios show how well the company uses its assets. Asset turnover ratio hovers around 0.7x, which is moderate, showing improving revenue generation from assets. Receivables turnover. Efficient, as most revenue comes from direct-to-consumer online subscriptions. Inventory turnover. Low inventory due to the nature of its telehealth business. That's a good sign in this case. 4. Leverage ratios, solvency. Now let's check how much debt the company is using to fuel growth. Debt to equity ratio. HIMS has a very low debt to equity, typically under 0.1, which is very conservative. Interest coverage ratio. They can easily cover any interest payments, which means low bankruptcy risk.
5. Market valuation ratios. Let's assess how the market values HIMS. Price to sales, PS. Around 3x to 4x, depending on market volatility. This is reasonable for a high-growth tech health stock. Price to earnings, PE. Still not meaningful due to negative earnings, but trending toward profitability. Price/earnings to growth, PEG. Once earnings turn positive, PEG could become a critical indicator of value. 6. Leverage metrics, DOL and DOF. Time for advanced metrics, DOL and DOF. The leverage multipliers that amplify profitability. Degree of operating leverage, DOL. DOL equals sign percent. Change in EBIT per percent. Change in sales. HIMS shows a high DOL, ~35x. Meaning small changes in revenue have a big impact on operating income. High DOL equals sign high fixed costs. HIMS benefits massively from sales growth. Degree of financial leverage, DOF. DOF equals sign percent. Change in EPS per percent. Change in EBIT. Since debt is low, DOF is low, ~1.1x. That's a good thing. It shows HIMS isn't exposed to high financial risk.
7. Final thoughts. Is HIMS financially healthy? Strong liquidity, low debt, improving profitability, high operating leverage, still waiting for consistent earnings. So while HIMS isn't fully profitable yet, its strong margins, low debt, and scalable model make it a promising long-term play, especially if it keeps up its growth pace. Our intrinsic value analysis points to a fair value gaps range between $7.96 and $19.35. With HIMS currently trading around $49.47, the stock sits well above every fundamental estimate, indicating that the market is pricing in near-perfect execution on ambitious targets. Overlaying this range onto the one-year descending channel, the technical picture aligns. The optimal buy zone lies near $20, where channel support meets the upper end of the fair value range, while the prime sell zone forms around $50, where the upper trend line intersects recent highs and signals fundamental overvaluation. If HIMS pushes above $60, surpassing both the channel ceiling and the fair value maximum, that would be a clear sign to step aside until a deeper pullback restores a favorable risk-reward setup.
For the full financial model, interactive ratio spreadsheet, and live screens, visit emaam.com, your hub for professional-grade analysis and actionable market insights. If you found this deep dive valuable, hit subscribe and tap the bell so you never miss our next high-conviction setup. Give us a like, share your price targets in the comments, and follow us. We'll keep uncovering the next breakout opportunities you won't want to miss.